Hi, everyone, and welcome to this month's edition of On Track. It's the 25th of June as I record this, and I'm recording for all our performance numbers up to the end of May and all the news up to date. As usual, I'll just point out that this video is designed for clients of McGregor Wealth Management, and particularly those that use our care investment methodology and portfolios. For everyone else, absolutely welcome to listen in, but please get advice before you act on anything that comes up during this video. So let's jump in. I'm going to update all the markets, and I'll just give you a spoiler alert. There's not much happening in the markets, not much change from last time. There's a few little things, and I'm going to dive into at the end some interesting observations about where the property markets might be going and a massive transfer of wealth occurring in the next decade. So firstly, on the news, shares are kind of stuck in a trading range, and you can see the bottom right chart here in the Australian market, which is the blue chart. You can see we've been going up, but we've been just not quite bouncing around and consolidating there, waiting to see what direction inflation sort of comes out at and whether we have much of a slowdown. Now you can see it's a different story in the S&P. The S&P's had a straight up sort of market, but it's actually a tale of two markets. And in the next slide, I'll talk about the impact the Magnificent Seven is having on the S&P, and it's dominating the performance over there. And it's actually a tale of two markets where the rest of the S&P is quite average, but the Magnificent Seven is extremely strong. The good news is, as index investors, we own both of those, so we're benefiting from that. And you can see the blue bar charts here, just in the middle of the page, shows the story, which is inflation. So over the last 5 years, inflation smashed during COVID, then out of the bag and up to around 8% in both Australia and the US. The US is on the left, Australia on the right. And then we've come back down into a range which is just above the band that the Reserve Bank and the Federal Reserve would like to be. So while it's lowish in that 3 to 4% range, it's above the 2 to 2.5%, which is kind of their target. When we look down at the numbers in all the markets, there's not much changing, no change in cash rates, almost no change in the 90-day bank bill rate. Slight drop in the 10-year bond yield, but just back to where it was 2 months ago. Not much change in the Aussie dollar. CPI, we're waiting on this month's number, but it's stubbornly stuck in that range. US inflation, once again, stubbornly stuck around the 3.4%. Mortgage rates, no change at all, and the same on term deposits. So as I said, not much of a change, but as I go through. Performance, we're sitting at the end of May. We've got 3 trading days left of the financial year. So we're going to finish it close to these numbers. So it's going to turn out to be a good year. As you roll your eyes down the 1 year, you can see that for the care balance portfolio is going to end up with a 12% year. That's a great return. It's certainly the top of the pack there, and it'll be a great result for balance investors this financial year. Higher for growth and high growth, higher again for the active portfolio. And a good results, around 15% for those high growth markets. No change to our view of the world. We've still got our dial at 8, which is just above fair value. Once again, that's not designed to trade. It's just designed to tell us roughly where we are in the emotional cycle of the market using our wall of worry framework. Let's have a look at the Magnificent Seven. There's a headline here: Magnificent Seven influence over the S&P 500 has never been greater. Now, firstly, the S&P 500 is the top 500 stocks in the US. So it's their equivalent of the All Ordinaries Index. Now, I'm going to start in the top right-hand corner here. And this top right-hand chart shows the performance on the right-hand side in 2023 of the S&P. So the purple bar here said last calendar year, to December 2023, the S&P gained 26%, which is amazing. But when you look at what the S&P did without the Magnificent Seven, which is the dark blue, it's about 12.5%. And at the end there, it shows NVIDIA, which did 239%. Now, the S&P, the Magnificent Seven, 107%. So you can see that Magnificent Seven. And once again, that's Facebook, that's Google, that's Amazon, that's NVIDIA, and that's Tesla. They're the big companies that are going to benefit the most, the market thinks, from AI. Now, it's likely the AI wave will benefit, firstly, those companies that are selling stuff around it, but ultimately it will benefit all companies. And this is where we're going to see the stock market firstly deliver rewards to the AI companies, but they'll realize that as AI comes into the mainstream, it's going to make all companies more profitable. and the profit will then boost those other companies. So once again, the benefit of indexing investing, we don't have to time any of that. We get the benefits of both of it. Year to date, 2024, the same story, 15.4% for the calendar year so far for the S&P 500, which is a great return, but it's 34% for the Magnificent Seven, 8.6% for the rest of the market, and 155% for NVIDIA. NVIDIA is the chip company, so that is silicon chips that go into supercomputers and other things that drive artificial intelligence. And it's quite amazing. People think, oh, maybe that's bubble territory, but let's have a look at some of the underlying numbers. Now you can see here, this top left-hand chart shows the growth in sales. The grayish sort of bar is over 3 years, and the blue bars are over 5 years. So NVIDIA is the highest one there. And you can see over 3 years, it's grown on average 54% per annum, its sales. So the amount of stuff they're selling is growing by 50% each year at the moment. Yeah, so that justifies a lot of that. You can see also Tesla, almost as much, 45%, and then massively high numbers for the rest of it as well. As we drop to the bottom left, you can see the sales per share growth and the same sort of numbers, phenomenal sales growth per annum compared to the broader S&P. And you can see the S&P is the lowest one there, the grey. The S&P 500 is the black, and the Magnificent Seven is the maroon. So you can see that massively high growth from the maroon, the Magnificent Seven, is driving the S&P, but it's also justifiably so. And when we look at US stock analysts, their forecasts for growth rates for the next 3 to 5 years for the these Magnificent Seven stocks, you can see their sustainable growth rate is massively high. For Apple, 124%, for NVIDIA, 114%. So that's the earnings growth rate across 12, 14% over that time. So these companies are delivering massive growth, which justifies the valuations at the moment. Whether it's gone too far on it, only time will tell. It depends on how accurate the analysts are. But as I said, the benefits of AI will eventually affect and impact positively pretty much all companies as they get productivity gains out of using AI effectively. So this is what I think will drive the next decade of stock returns and productivity. And it will come with roller coaster potentially in the share market. We haven't really seen the start of a crazy boom yet. I dare say at some stage in the next decade that will happen. Very hard to tell whether that's 1 year, 2 year, 5 years, but it will happen. And by the time we have that boom, we've usually forgotten what a boom feels like, and we start to feel like it's getting too far ahead of itself. As always, we'll be incredibly focused. So just to remind ourselves of what the last 20 years looked like, this was the boom we had back in Australia in 2005 through to 2008, largely driven by commodity prices in Australia, the commodities boom. And it went up, then it went down, but it had been a solid time. And over time, as I said to someone today, if you'd fallen asleep in 2005, woken up in 2010, you would have worried. You would have wondered what all the fuss was about, because markets had just gone up the average amount. And I love this quote from Peter Lynch. I'll say it again, as I often do, but far more money has been lost by investors trying to anticipate corrections than lost by the corrections themselves. It's folly in the investment market to be trying to predict all these 5, 10, 17% downturns. It is more likely to be able to detect when we're in the territory of a major downturn. Not saying no one, including us, are going to predict it to the precision, but you can kind of tell when the market's running hot. And that's where our framework, which we call the wall of worry, goes through that fear, FOMO, and into the wall of worry. We're quite firmly, as I said before, right in the middle of the wall of worry at the moment. So we don't look at any danger. As we look at interest rates, and I'll look at the bottom charts first. So both the US and Australian 10-year bond rates at about 4.2%. They're kind of going sideways at the moment as this market waits to see whether inflation is going to drop through or whether we're going to need more rate hikes to push the economy into further slowdown to drop inflation. The Federal Reserve and the Reserve Bank of Australia are obsessed with seeing that come down because they don't want inflation to get out of the bag and get entrenched in wage rise, etc. So we're in a bit of a limbo at the moment, waiting to see where that data comes in. And I won't go through anything here. It's just our A picture of the wall of worry, and as I said, quite firmly in the middle of the wall of worry at the moment. Um, Reminder that all those downturns eventually recover. But I'm going to flick through a few here. And a new behavioral bias, and this is one you've all heard of, but it's a rule of thumb, and rules of thumbs can be useful, or they can be horribly not useful as well. Because a rule of thumb can be a guide to sensible practice and simplified advice, basic rule setting that gives us, as they say, a rule of thumb. It's almost hard to define it because it almost defines itself, but it's a guide and a principle for certain things. But the key issue is they're not scientific. They don't take into account individual circumstances, either of a person, but also or of the market at that particular time. There used to be rules of thumbs about how much you should pay for a house based on where you're investing, how much someone should pay for their first car, all that sort of stuff. And while it can be helpful, it's not necessarily a guide. We hear rule of thumbs about things like price earnings ratios, which is the way to value the share market, that high price earnings ratios can be bad and it's going to lead to market crashes. But it's not always the case, at least not in the shorter term. It can just be an indication that we're about to have growth. Eventually, it certainly can lead to that. It's certainly rules of thumbs not to be relied on. They can be listened to, but certainly not relied on. I want to point out that whenever we're in a stable time, we've had good returns. Always the reminder is that volatility can return at any stage, both upwards and downwards. So never to expect the market to stand still for too long. Let's have a look at what the markets did in May. So Aussie shares had a quiet month, up 0.84%, looking at about 12.8% for the year. So it's going to end up as a pretty solid year, assuming nothing drastic happens in the next few days. The beautiful diversification we get through holding the top 10 stocks account for a fair chunk of the 300 stocks that sit in VAS. And you can see boring, beautiful, $10,000 invested over the last 10 years, assuming dividends reinvested would have grown to about 22,900. So a stellar return. What was a pretty average 10 years, really. So only a 7.72% growth rate. But in a low inflation world where inflation was close to 1% for most of that, it's a reasonable return for the decade. When we go to US shares, extremely solid, up at about 12% for the decade. You can see what that's done. And the extra bit of compounding, $10,000 grown to 43,000 here. An absolutely magnificent return. So a quadruple for Australian investors who had US share investments. And that's just in the index. And you can see in the individual stocks here that magnificent seven dominating Microsoft, Apple, Nvidia, Amazon, Meta, which is Facebook, Alphabet, which is Google. There's six, and you add to that Tesla to give you the magnificent seven. The other ones rounding out that top 10 are Berkshire Hathaway, which of course is Warren Buffett's company, Eli Lilly, a health or drug company, and Broadcom, which is another chip manufacturer, similar but different to Nvidia. So yeah, just over fair in terms of our valuations there. Global leaders almost identical to the US market. You've got some slight differences at the bottom of the ladder there. Once again, dominated by the Magnificent Seven. IOO sits in the active portfolio, and it also has seen 10,000 through to 40,000 over the last 10 years. The year's going to close out at 25%, a solid return, but once again, completely dominated by the Magnificent Seven that probably accounted for about 20% of that return. We go to US small caps, a solid year, 16.8%, but you can see the 3 years pretty slow, 5.5. But ironically, over 10 years, US small caps are on top, 10,000 growing to 43,600. But they had a stellar growth rate in the lead up to COVID, not quite as high post that, but still solid. Nonetheless, these are less known names, US small caps, even though they're smaller caps compared to US companies. They're not so small when compared to Australian companies. But yeah, fair value, we have those at. Emerging markets is kind of the problem child at the moment. Its year turned out not too bad in the end, 8.2%, but you can see the 3-year average at -2%, the 10-year average about 5%. So still way better than cash over that period. But you can see that's meant value of 10,000 just growing to about 18,000. We do expect this will turn around at some stage. Over the long run, emerging markets will often outperform major markets, but they do it in different cycles. And this has things like, let me just go back, Taiwan Semiconductor, they make chips as well. Then it's got some of the Chinese companies, Tencent, etc. Now, the price earnings ratios on the Chinese companies are quite low at the moment. There's been a perceived sovereign risk. That just means the risk of the government in China doing naughty things. So investors are only willing to pay less for those at the moment. They're extremely profitable. And over time, as people judge that sovereign risk to lessen, if it does, they may provide incredibly above average returns, and they remain an important part, albeit a small amount of the portfolio. So we go to gold, and gold has just been rock solid over the last 5 years, averaging 13%. The last year will be 16%. And it's often been going up when other things are going down. So it's been a magnificent hedge. Over 10 years, about 9.6%. That has been the value of gold in terms of this exchange traded fund, grown from about 10,000 to 25,000. A really good part of the portfolios as well. Let's jump into the property market, and we use a similar cycle, but this one we just call boom bust boring. Property market goes through long periods of not doing much, followed by short periods of boom. We're certainly at the tail end of that in many places around Australia, and then upturn. Although I'll go through some forecasts in a minute. This is looking backwards at the capital cities, so we can see that the change year on year, about 8% for Sydney, 15% for Brisbane and the Gold Coast, 14% for Adelaide, and 22% for Perth. Amazing return from Perth. Similar for units. The average across all the capital cities, 10%. So yeah, a great year for property investors. Makes it tougher for first home buyers, but certainly for property investors, a great year. This was interesting. This came out during the month, which was a forecast of where prices might end up for financial year 25, so a year from now. And let me just preface by saying it's a brave person that does forecasts. Mind you, if you look at the percentage changes, they're pretty much just saying from 0 to 10%, depending on the cities. So that's not that brave, and that's kind of in the averages. For Australia-wide, they're saying 3 to 6%. The long-term growth rate in Australia is about 4%. So it's not that brave. But what I found fascinating was looking at the median price forecast. So Sydney's going to end up by the end of next year at about 1.7 million. Melbourne about 1 million. Brisbane not far below that. Perth not far below that. Adelaide similar, just under 1 million. So we're knocking on the door where every capital city in Australia will have a median price of $1 million. That means the median is just half the properties are above, half are below. So it's the property in the middle. If you look down the bottom to the Sunshine Coast and Gold Coast, also north of 1 million. Still value in regional Victoria, Queensland, and to a lesser degree, New South Wales. This may continue the trend of people moving to the regions, which will help solve some of the housing crisis. We're certainly seeing that at the moment with solid performance in regional cities. Fascinating headline I saw, and this one we've been talking about for years, but there's a massive wealth transfer commenced in Australia as baby boomers and their parents are passing away, and often they've sat on properties for years and years and years. So one article here, and I've got cuts from 2 articles here, but one article was showing 3.5 trillion as the amount to transfer over the next 20 years. The other article reckons it's going to be 4.9 trillion for the next decade. And that's a staggering amount. Now, this is going to help in some ways, and it's going to hinder in some ways. So what happens here is that the younger generation, keep in mind, often the average age of people inheriting is in their 50s to 60s to 70s. So some of this money is predicted it will transfer down. So what they've got here, this estimate is out of the 4.9 trillion, 2.3 trillion will be inherited by children of the baby boomers, 1 trillion will make its way to the grandchildren, and 1.7 million is slated for various charities. We're seeing this in our client base. I'm seeing this. My generation are losing their parents, so people in their late 50s to mid 60s, parents obviously hitting mid 70s to 90s. So that's the impact, and we're seeing this transfer occur. Now, for those that are going to be on the positive end of these inheritances, that will help clear debt, that will help keep the property market solid, and some of that will pass to grandchildren, which will help them get established in property markets. But the great divide is for those that won't benefit. They will have to work harder than ever to pay for property prices that will be inflated and show no signs of going down. But as I said, anything can happen. And if we had persistently high interest rates, that may slow this. But on the flip side, if we get lower interest rates, that will certainly keep property prices solid. So good news for property investors, tougher news for property buyers, yeah, particularly young buyers. But on the flip side, some of this money, for those that are lucky enough, will find their way to pay off mortgages or buy properties. And it's really the ones that are not going to benefit from any of that, and the younger generation there that are going to have trouble. So it's going to create two classes, those that are going to struggle to ever get into property and those that won't. Makes it a little bit more like Europe, which has had these sort of economics for years. So let's have a look at mortgage rates, and completely boring, no changes, just sideways. So you can see that fixed rates are still high, above that cash rate there. Variable rates, there's not much difference at the moment in terms of fixed and variable. We certainly wouldn't be suggesting fixing. It is likely, more likely than not, the rates will go down, but that's just probable. Doesn't mean it's indefinite. It just means it's probable, and potential rate cuts somewhere between November and February coming up, with no sense of certainty. Do I say that? I've thrown back to Heron Todd White's property clock here just to get a different perspective, but you can see things are still rising, lots of regional areas as well. And it's interesting that Heron Todd White are more optimistic around Sunshine Coast, Central Coast, Wollongong, Newcastle, those semi-regional areas that are seeing money flow to them from Sydney, Melbourne, etc. So not many on the decline. There's some specific parts of Tassie and New South Wales predominantly that are coming down, some bits of WA, but mainly those New South Wales, and a few tips from them, which is kind of peak of the market once again around some of those regional areas as well. But it's interesting. Heron Todd White have Melbourne, Sydney all on the rise again, which is pretty consistent with some of those numbers we looked at before. So hopefully you've got a look at that. Not much going on. As always, we don't mind that. Exciting life, boring money is our motto. So yeah, not too much interesting this month. So it's a bit quicker than normal. Once again, just reinforcing a process. We just believe all investing is best done as part of a real plan with your goals and your circumstances based on your individual life. Portfolio is then designed to meet that, where we take a long-term view where the boring things can come and do their hard work, which is diversification, good quality asset allocation and liquidity, and low-cost access through most of the growth markets. We do occasionally tap into active managers where we have a view that it might get better than the index. We certainly had a lot of success with that on the fixed income front over the last 5 years. And then that protection against the inevitable short-term volatility through reserves, which is just some lower risk investments for our retirees, and dollar cost averaging for our wealth builders, which just means they're regularly investing monthly into the market and rebalance regularly the boring stuff. There's been plenty of rebalances over the last year in the portfolio, which happens without you having to do anything. Once again, only 3 ways to lose money: panic and sell, have to sell, and not properly diversified. Thank you for your attention. I do appreciate it, and I hope you have an exciting life most of the time. I know there's plenty of hardships going on from time to time for people as well. So always thinking about clients who are losing loved ones or other challenges at the moment. But in general, it's a reasonable backdrop for the finances of all of that at the moment. So until we meet again, Rob McGregor signing out.